Hey, you are listening to What the Sigma with Chad Stacks. Today on the show, Elon Musk just filed to take SpaceX, Starlink, xAI, and X public together in a deal that values the combined company at $2 trillion. But here's the catch. Starlink's $4.4 billion in annual profit is basically being used to cover xAI's $6.4 billion loss, and new shareholders would have no voting rights, no ability to sue, and no say in anything. Starlink earned $4.4 billion in operating income last year. xAI lost $6.4 billion. Elon Musk just filed to take both public in the same wrapper at a $2 trillion valuation, and one of those numbers is paying for the other. We'll come back to exactly how that math works, because the structure is either genius or the most aggressive sleight of hand in IPO history, and the answer depends entirely on which pages of the S1 you actually read. Let's start with what's real, because there is something genuinely real here. Starlink is a scaled, cash-generative infrastructure business serving 10 million customers across 150 countries with roughly 10,000 satellites in orbit. That is not a narrative. That is an operating network generating $4.4 billion in operating income in a single year, with the most recent quarter alone printing $1.2 billion in profit, which according to the filing represents more than two-thirds of consolidated revenue. If you stripped everything else out and valued Starlink as a standalone satellite ISP with those numbers, you would have a serious asset. The kind of asset that anchors a public offering. The kind of asset that makes the rest of the structure financeable. And that is precisely the point. Musk is using a real profitable infrastructure business as the balance sheet anchor to take public a holding company that also contains xAI and X, both of which would face dramatically worse standalone valuations if they had to stand in front of public markets on their own merits. Here is the number that should stop you cold. Q1 2026 net loss. $4.27 billion. Q1 2025 net loss, $528 million. That is an eightfold deterioration in 12 months, disclosed in the same filing asking public markets for $75 billion. No source in the coverage decomposes that swing. The obvious candidate is stock-based compensation from the $1 billion performance-based Class B shares granted to Musk in January, but nobody quantifies it. That gap matters because if most of that $4.27 billion is non-cash comp, the operational picture looks different than the headline. If it's not, you have a company whose losses are accelerating at a rate that no revenue growth story cleanly explains. The full year 2025 numbers are less dramatic, but structurally important. Revenue of $18.7 billion, up 33% from $14.1 billion the prior year. Operating loss of $2.6 billion. Accumulated deficit as of the end of March, $41.3 billion. Now here's the thing about that $2.6 billion consolidated operating loss. xAI alone lost $6.4 billion in operating income in 2025. That number is larger than the entire consolidated loss, which means the legacy SpaceX plus Starlink business taken together was profitable on a standalone basis. xAI is the whole. The rocket business and the satellite ISP are covering it. Existing SpaceX investors, per reporting, called the X and xAI acquisitions bailouts. That word is doing serious work. The S1 does not detail the exchange ratios, the valuations used in those transactions, or whether independent committees approved the related party deals. That is the single most important governance question in this entire filing, and mainstream coverage is almost entirely silent on it. We'll come back to that in a moment, but first, the Mars clause. Every outlet led with it. Musk's compensation package requires, among other conditions, a Mars colony of at least 1 million inhabitants before full vesting. That is a vesting trigger that is not vestable on any realistic timeline, and it functions primarily as optical cover for the other 14 market cap-based tranches that are structured as 15 grants of 67 million shares each, totaling approximately 1 billion shares, with full vesting requiring a $7.5 trillion market cap. The Mars clause is the headline. The $7.5 trillion market cap requirement is the actual structure. AP breaks it down by tranche. Fortune frames it as a single condition with the Mars colony as the anchor. Same package, different framing, and the AP version is more analytically useful. Now to the governance, which is where this filing earns its place in history for reasons that have nothing to do with rockets. Musk holds 83.8% of voting control pre-IPO via Class B shares, dropping to above 50% post-offering. Fortune cites 85%. The difference is likely pre- versus post-offering basis, and the coverage doesn't reconcile it. Either way, the S1 says it plainly. Musk will have the power to control the outcome of matters requiring shareholder approval, including the election of all directors. The filing also warns investors directly that this structure will limit or preclude their ability to influence corporate matters. That is the company telling you what you are buying. But the voting structure is only one layer. The filing also includes mandatory arbitration, class action waivers, and Texas incorporation under governance law that one analyst described as largely untested. Bruce Herbert, CEO of Newground Social Investment, put it this way: the structure closes the voting door, the courthouse door, and the proposal door simultaneously, and called it unprecedented in terms of creating a total lack of accountability. That framing is accurate. This is not sloppy governance. This is the most aggressive shareholder rights compression ever attempted at this scale. And it is legal because the SEC issued a policy statement in September of last year permitting mandatory arbitration in IPOs. Without that policy shift, this structure does not exist. No source in the mainstream coverage examines who lobbied for that change or which other large IPOs are now queued to use it. The Texas incorporation is also borrowed directly from the Tesla playbook. After a Delaware judge voided Musk's $55.8 billion Tesla pay package, Tesla re-domiciled to Texas, and Musk received a new package potentially worth more than $1 trillion. SpaceX is using the same Texas governance regime preemptively before any public market accountability exists. The only person who can fire Musk is Musk. That is Reuters paraphrasing the S1, and it is not an exaggeration. One more angle that nobody is covering: the governance structure, per reporting, potentially makes it easier to merge SpaceX with Tesla later. That is a buried implication in the R's analysis, and zero other sources touch it. If you are pricing SPCX at a $2 trillion valuation, and you are not modeling the optionality of a future Tesla merger under a governance structure that gives Musk unilateral control of both companies, you are missing a variable. The federal government concentration is also underplayed. 20% of 2025 revenue came from NASA and DoD contracts, representing $6 billion over 5 years. No source breaks out what percentage is Starshield or classified programs, and no source models the political risk tied to the Trump-Musk relationship in a post-Trump administration. That is a customer concentration question that belongs in the risk section of any serious analysis of this offering. The roadshow is eligible to begin June 4th, 15 days post-filing. The reported target is $75 billion at a $2 trillion-plus valuation, which would nearly triple Saudi Aramco's $26 billion record from 2019. The ticker is SPCX, dual-listed on NASDAQ and NASDAQ Texas. Here is what this filing actually is. It is a Starlink IPO with a rocket company and an AI lab attached as cost centers, wrapped in governance architecture designed to ensure that public capital flows in and public accountability does not. The Starlink business is real, and it is strong enough to anchor the structure. The question is not whether Starlink is worth owning. The question is what you are actually buying when you buy SPCX. And the S1 is unusually honest about the answer. You are buying exposure to a profitable satellite ISP, a money-losing AI lab absorbed via related party transactions that existing investors called bailouts, and a governance structure in which your vote, your lawsuit, and your ability to propose anything are all contractually subordinated to one person before the opening bell on day one. Remember, nothing said in this podcast is financial advice. This has been another fire episode at What the Sigma. Smash that follow button and tap 5 stars to spread the butter. Fortune favors the bold, baby!
Grab news. Thomas.